What are the basics of investment? Learning the fundamentals of investing is akin to taking up a foreign language. It's quick to become disoriented or overwhelmed. The good news is that once you've learned some investment fundamentals, you'll have a greater understanding of how your capital is spent for your long-term goals. To help you along the way, here are a few of the most popular forms of investments you'll come across in your lifetime: stocks and bonds, mutual funds, and real estate. The fundamentals of stocks. Historically, stock ownership has become the most successful way to accumulate money. Bond investment has been considered one of the best ways to make money for more than a century. Stocks are ownership shares of a particular company. When you buy a share of Apple, for example, you are purchasing a small portion of the business. Stock prices fluctuate in response to a company's results as well as the overall economy. Exchanges are where public corporations list and sell their stock. There are a number of exchanges in the United States and around the world. Some businesses issue stock but keep them private, which means they don't sell on a stock exchange. You can buy and sell stocks in any quantity you want with no obligation to keep them for a set period of time. The open stock exchange determines the market price of a single share based on supply and demand. To process your order to buy or sell a stock, your broker will normally charge a service fee or commission. These investments are rated according to the financial stability of the underlying business. Dividends are paid on a daily basis on some stocks, although they are not paid on others. If the value of the shares rise above what was paid for them, investors will earn capital gains. You'll have to pay capital gains tax on income if you sell an investment for more than you paid for it. Fundamentals of bonds. In the meantime, when you purchase a bond, you are lending money to the corporation or organization that issued it. Bonds are debt instruments that include treasury bills, municipal bonds, corporate bonds, and other forms of debt. You're lending money with the expectation that the borrower can repay you by a certain date. The creditor will pay you interest on a daily basis before they pay you back. Bonds, like stocks, are graded according to their quality, with AAA being the highest. A bond's ranking is calculated by rating agencies such as Moody's. Owing to the volatility of the underlying business, some bonds are referred to as junk bonds, and they are riskier to hold. Bonds must be kept for a certain amount of time until they mature. You can, however, resell them through your broker on the secondary market. Your broker will charge a fee to complete the transaction once more. You're lending money to the school system in the case of a school bond, for example, to create a new high school or boost classroom conditions. Purchasing a company's bond entails lending money to the company, which it will use to expand its operations. Mutual funds saving. Mutual funds are one of the most common ways to invest in stocks and bonds. In fact, most people are statistically less likely to own individual assets than mutual funds kept in their 401k or Roth IRA. Mutual funds provide numerous advantages to investors, especially beginners who are still learning the ropes of investing. They're simple to understand and allow you to spread your investments through several companies. Mutual funds, on the other hand, have a few serious drawbacks. They charge fees, which can eat into your earnings, and certain funds can increase your tax bill even though you don't sell any shares. Mutual funds are mutual money savings with a particular target in mind. For example, you might come across a mutual fund that tracks a specific index, invests predominantly in a specific region of the world, or concentrates its assets on a specific company size. You and hundreds of other people give money to a fund manager who invests it in a range of holdings. The fund's manager invests the pooled funds in assets that are in line with the fund's stated objective. The specialist will buy and sell portfolio holdings as well as return income to investors on a regular basis. These investments will charge a variety of fees to cover the cost of fund management and promotion. The net asset value, NAV, at the market's close is used to price mutual funds once a day. Any trades you made with the fund are completed at that time and at that amount. To purchase or sell these holdings, there's typically a broker charge. Investments in real estate. There are many people in the world who believe that real estate is the only investment that makes sense. If you agree with that theory or not, there are more opportunities than ever to diversify your real estate assets. Yes, you can purchase a home for yourself or rent a property. However, a real estate investment trust, right, is a type of security that you can buy. Right. A licensed manager manages the individual assets kept within the trust portfolio, similar to how a mutual fund does. In this situation, though, all of the assets are in real estate. Land, shopping centers, apartment complexes, senior citizen facilities, and even medical marijuana facilities are all examples of rights that concentrate on tangible property. A fund must meet strict benchmarks set by the Internal Revenue Service to qualify as a right, the IRS. Structures and entities for investing. You come across various types of investment companies as you step past stocks, shares, mutual funds, and real estate. Millions of citizens, for example, would never buy a stock or a bond. Rather, they put their money into a family business like a bakery, a convenience store, or a rental property. Yes, these are companies, but they should also be seen as investments and treated as such. Hedge funds and private equity funds, as well as futures and options contracts, are expected to draw more seasoned investors. Others will use their broker to acquire shares in publicly traded limited partnerships. These unique legal mechanisms may have significant tax consequences for you, so it's important that you understand how investing in them can help as well as hurt your finances. Investing in a downturn. It is the essence of the universe that bad things happen from time to time. You do not need to be concerned if something goes wrong with your investments or savings. Often, you have to take a hit in order to make money again, and waiting until the crisis is over is always the safest strategy. Aside from reading and studying as much as you can, consulting with a financial planner or accountant who can help you better understand the world of investing is one of the best things you can do. The information is being given without taking into account any particular investor's investment goals, risk tolerance, or financial circumstances, and may not be appropriate for all investors. Past success does not guarantee potential outcomes. Investing entails risk, including the possibility of losing money. If you want to know more financial tips like these, make sure to give this video a like and click subscribe. Thanks for watching, and see you in the next video.